One of the world's biggest banks, Credit Suisse, has become the latest casualty of the banking crisis. Now its biggest rival, UBS, is taking it over.
This is no bailout. This is a commercial solution.
The scandal-plagued bank's latest troubles began after admitting lax financial controls in previous years.
The bankruptcy of a global systematically important bank would have caused irreparable economic turmoil in Switzerland and throughout the world.
The government-backed deal will see UBS pay just $4.8 billion for Credit Suisse. The Swiss Central Bank will provide $160 billion in liquidity assistance, and the government will guarantee losses up to $14.5 billion.
UBS will remain rock solid.
The rescue deal follows the collapse of two regional US banks and an emergency lifeline for another. In addition, 6 central banks announced they would boost the flow of US dollars through the global financial system. The Reserve Bank is hosing down fears our banks could be impacted.
What we're talking about here is a few institutions that were poorly managed and did not meet those higher standards.
It's not yet clear if the deal's enough to restore trust in lenders around the world. Job losses are inevitable, and financial markets are now betting that central banks will stop hiking interest rates.
Just one of many things that the board will be taking into account when it makes its decision next month.
Raising interest rates push you into more of a recession. However, perhaps this banking crisis pushes you towards a recession anyway.
The R word that's getting harder to avoid.
So will the banking megadeal avoid a full-blown financial crisis? Former investment banker Mike Mangan expects more contagion, especially if the US Fed raises rates this week.
One of the things that's driving this, and I'm not sure central bankers are really on top of this, but every time they raise interest rates, they ratchet up the pressure on the banks. And there'll be, not all banks, but there'll be some banks on the periphery that'll be exposed. And so we've had 3 that have fallen over in the last 10 days. 2 because of unrealised losses on their US bond portfolio, and CS because there's just been a general lack of confidence because they've had a few foul-ups in execution. But I suspect that if the US raises interest rates on, I think it's Wednesday, you're going to see more pain and a few shrieks.
Pain in which areas? In just the regional banks or those systemically important banks?
Well, the thing about a contagion is you don't know where it's going to pop up. I mean, 10 days ago, no one had any, or maybe 2 weeks ago, no one had any idea that Silicon Valley Bank was a problem. And then it all blew up in like 2 or 3 days. No one really expected. I'm shocked. I mean, I worked for Deutsche Bank for many years, and CS was a competitor, and I respect them. And I'm shocked that it's come to this. So you just don't know where it's going to come out. But I'll tell you where there is one pressure point. What they've done, what Yellen has done in the US, is that she's implicitly guaranteed the deposits of all the large banks. So Bank of America and JP Morgan, any depositor there over $250,000, they've got an implicit guarantee. But America's got thousands of banks. And if you're in one of the others, like the other 3,900 banks that aren't implicitly guaranteed, and you've got more than $250,000, you're thinking right at the moment, should I be moving my money? And if enough people do that from whatever bank, then that's where the contagion continues. It's like a bushfire. We've had 15 years of zero interest rates. That's the furnace that's been created, and someone's lit the match, and the fire is off and running.
Well, we know the Fed is now sitting on huge losses with its exposure to the government bonds, the long-dated ones. Just how strong do you think the central bank is?
Well, technically it's insolvent, but only if they're forced to sell those bonds. Now, they will argue, and it's a good argument, that they'll just hold the bonds to maturity. So they are technically insolvent, but I think, you know, because they're the Fed and they're backed by the US government and they can hold the bonds to maturity, they're probably okay. The one I'd be more worried about is the FDIC, which guarantees bank depositors in America. Now, they may be, their entire portfolio is US bonds, the same instrument that brought down Silicon Valley Bank. and they're sitting on huge unrealised losses. But if they're not forced to realise the losses, they just sit there in the books, and everyone sort of pretends they don't exist. But if they're forced to sell because you've got a number of banks that are people are pulling out their deposits, and the number of banks fall over, and the FDIC is forced to sell their securities, then you could have a problem. Now, we're not there yet, but it is possible.
Well, we know that this has moved at breakneck speed. Just looking at bonds
Absolutely.
more broadly, I mean, can they still be considered safe in light of what we've seen over the last week?
At the end of the day, they're backed by the guarantee of whatever government has issued the bonds. I presume we're talking about government bonds because they're only as good as the country's backing. Now, this gets into the area of huge federal deficits, huge federal debt. I think last I saw it was like 31 trillion, I think from memory, is the US federal debt. And if enough people, we're not there yet, but if enough people start to question that, then you start to question, why am I owning this stuff?
Yeah.
And that's, I mean, the reason gold has performed so well in the last probably 10 days is people are asking those questions and they're not hanging around for the answer.
Yeah.
They're shifting from paper. I mean, at the end of the day, government bonds are just an IOU. So they're shifting from the IOUs into something that's solid.
Flight to safety. Just how illustrative is SVB, Signature, now Credit Suisse collapse in terms of the risk to the broader banking and financial system?
Well, they've cauterised those particular banks. As I say, we're getting into the area of human psychology. It's almost like a psychologist would be able to give you a better answer as to where this is going to go, a better answer than an analyst or an economist, because it's human psychology now. It's not numbers, it's just fear.
When we look back to the GFC and some parallels there, I mean, we saw Lehman's fail during the GFC, but other banks were rescued. I mean, did the GFC really solve any of the problems about risky debt, or has the can just been kicked down the road?
I think the can has been very much kicked down the road, and a lot of us have been saying that for the last 15 years. And they tried to raise interest rates, I think it was in 2019, and they only tried, I'm talking about the US, they only tried that for about 3 or 4 months. I think the stock market fell a quarter, and then they backed right off because they realised that what's happened over the last 15 years is financial players have leveraged themselves into a zero interest rate or even a negative interest rate policy environment. And then so we've had that for 15 years, and then last year we've had what, 9 or 10 interest rate rises, and that's what's causing the pain.
Well, there are obviously differences between now and the GFC. Obviously, we're not dealing with collateralised loans and there's no obvious links to the real economy. But what about the similarities? Because it's giving off the same vibe. You've got a UBS rescuing Credit Suisse, JP Morgan rescued Bear Stearns back in the GFC, and a frantic weekend of talks.
Oh, it's deja vu. If you lived through the GFC, you're finding it difficult to sleep of a night because it's exactly the same playbook. And the tragedy is that we've been told for the last 15 years, oh, we've fixed all the problems, and clearly they haven't.
So how can you fix those problems? Where do the solutions lie?
Catherine, this is very, very deep, and I think there is an immediate solution to this problem, and the immediate solution is probably to lower interest rates and to start quantitative easing again. Now, what that means is we've become addicted. We've become like a drug addict, where we've become addicted to QE or quantitative easing. We've become addicted to zero interest rates or even negative interest rates. And every time they try to normalise them, as we've seen in the last year, then you have all these sorts of problems that are cropping up.
Mike Mangan, great speaking with you. Thanks for your time.
Okay, thank you, Catherine.